Ever wondered how the stock market works? Like, what's all the hype about, and how do people actually make money from it? In this video, we're breaking down the stock market from the ground up, making it super simple for anyone to understand, even if you're a complete beginner. We'll cover everything from what stocks actually are to how you can start investing yourself. Now, I know finance can seem intimidating, but trust me, it doesn't have to be. Once you understand the basics, you'll realize it's not as complicated as it seems. Plus, learning about the stock market can be incredibly empowering. It's like unlocking a whole new world of financial possibilities. So, whether you're just curious about the stock market or you're ready to start investing but don't know where to begin, this video is for you. Let's dive in. Imagine owning a tiny slice of your favorite company, like Apple or Tesla. That's essentially what owning stock is all about. When you buy a share of a company's stock, you're actually buying a small piece of ownership in that company. It's like becoming a mini partner. But instead of actively running the business, you're investing in its success. Now, why would companies even want to share ownership? Well, it all comes down to raising money. Companies need capital to grow their businesses, develop new products, expand into new markets, you name it. Instead of borrowing money, they can issue stocks, which are essentially little pieces of ownership in the company. Investors like you buy these stocks, providing the company with the funds it needs. Think of it like crowdfunding, but on a much larger scale. When you buy stock in a company, you're essentially betting on its future success. If the company performs well, its value increases, and so does the value of your stock. You can then choose to sell your shares at a higher price than you bought them, making a profit. Of course, the opposite is also true. If the company doesn't do well, the value of your stock could decrease. That's why it's crucial to do your research before investing in any stock. Look into the company's financials, its management team, its competitors, and its overall industry. The more you understand about the company you're investing in, the better equipped you'll be to make informed investment decisions. Remember, investing in the stock market always involves some level of risk. But by understanding how stocks represent ownership in companies, you can start to see the potential rewards of participating in the market. So, you want to buy or sell stocks. Where does all the action happen? This is where stock exchanges come in. Think of them like giant online marketplaces where buyers and sellers come together to trade stocks. The most well-known stock exchanges in the US are the New York Stock Exchange, NYSE, and the NASDAQ. Back in the day, these exchanges were actual physical trading floors with traders shouting and signaling to buy and sell stocks. It was chaotic and exciting, like something out of a movie. But these days, most trading happens electronically. You don't need to be on Wall Street in a fancy suit to participate. You can buy and sell stocks right from your computer or even your phone with the help of online brokerage accounts. These online platforms have made investing more accessible than ever before. You can place trades, track your investments, and even get real-time market data, all at your fingertips. It's incredibly convenient and eliminates the need for traditional stockbrokers. Now, you might be wondering how prices are determined on these exchanges. Well, it all comes down to supply and demand. If more people want to buy a particular stock than sell it, the price goes up. Conversely, if more people want to sell than buy, the price goes down. It's like an auction where the highest bidder wins. Of course, it's not quite that simple. Many factors can influence stock prices, including company news, economic data, and even global events. Understanding these factors and how they might affect the market is all part of becoming a savvy investor. Okay, let's talk about everyone's favorite topic, money. Specifically, how are stock prices actually determined? Why does one company's stock cost $5 a share while another's is a whopping $500? It's not just random, I promise. As we discussed earlier, supply and demand play a huge role. If a company is killing it, think groundbreaking products, impressive earnings reports, a rockstar CEO, demand for their stock shoots up. Everyone wants a piece of that pie, driving the price higher. On the flip side, if a company is struggling, maybe they're facing lawsuits or losing market share, investors might start selling off their stock. This increase in supply, coupled with lower demand, can cause the stock price to drop. But there's more to the story than just current performance. Investors also consider a company's potential. Are they on the brink of a major breakthrough? Are they expanding into booming markets? These factors can create excitement and optimism, leading investors to buy in and potentially driving up the stock price even if the company isn't super profitable. Then there are external factors that can impact the entire market, not just individual companies. Things like interest rate changes, inflation, political events, even natural disasters can create waves of uncertainty or confidence, influencing stock prices across the board. Trying to predict the stock market's every move is nearly impossible, even for seasoned pros. That's why it's so important to focus on the long game, invest in companies you believe in, and remember that diversification is key. More on that later. Now that we've demystified some stock market basics, you might be wondering, how do I actually get involved? Well, there are two main approaches, investing and trading. Think of them as long-term relationships versus short-term flings ... in the financial world, of course. Investing is all about the long game. It's about finding solid companies with strong growth potential and holding onto those stocks for years, even decades. You're essentially riding out the market's ups and downs, believing that over time, the value of your investments will grow. Think of it like planting a tree. You nurture it, give it time, and eventually, it bears fruit. Investing requires patience, discipline, and a belief in the power of compounding. Basically, earning returns on top of your returns. Trading, on the other hand, is a much faster-paced game. Traders try to capitalize on short-term market fluctuations, buying low and selling high, often within days, hours, or even minutes. It requires a deep understanding of technical analysis, risk management, and a whole lot of attention to market trends. Imagine a trader as a surfer, riding the waves of market volatility. It can be exhilarating and potentially lucrative, but it also comes with higher risks. One wrong move, and you could wipe out. Whether you choose to be a long-term investor or a short-term trader depends on your personality, risk tolerance, and financial goals. There's no right or wrong answer, but it's crucial to understand the differences and choose the path that aligns best with your overall strategy. Let's be real, folks. Investing in the stock market always involves some level of risk. It's like that old saying, no risk, no reward. But understanding and managing that risk is crucial to making smart investment decisions. Here's the thing. The higher the potential return, the higher the risk. Think of it like a roller coaster. The taller and faster the ride, the more thrilling and potentially terrifying it can be. Stocks, for example, have the potential for high returns, but they also come with the risk of losing value, especially in the short term. Bonds, on the other hand, are generally considered less risky than stocks, but tend to offer lower returns. Your risk tolerance depends on various factors, like your age, financial goals, and how comfortable you are with market fluctuations. A younger investor with a longer time horizon might be more comfortable taking on more risk, while someone closer to retirement might prefer more conservative investments. Diversification is key to managing risk. Imagine putting all your eggs in one basket. If that basket falls, you lose everything. But if you spread your investments across different asset classes, stocks, bonds, real estate, etc., and within those asset classes, different sectors, industries, geographies, you're less exposed to the ups and downs of any single investment. Remember, investing isn't about getting rich quick. It's about making informed decisions, managing your risk effectively, and staying focused on your long-term financial goals. And hey, it doesn't hurt to have a little fun along the way. Ever heard someone say, the market is up today? They're probably talking about a market index, like the S&P 500 or the Dow Jones Industrial Average. Think of indices as report cards for the overall stock market. They give you a snapshot of how a particular group of stocks is performing. The S&P 500, for example, tracks the performance of 500 of the largest publicly traded U.S. companies, representing a broad cross-section of the market. The Dow Jones Industrial Average, on the other hand, focuses on 30 large blue-chip companies. These indices are like benchmarks. They provide a point of reference for investors to compare the performance of their own portfolios. If your investments are consistently outperforming a particular index, you're on the right track. But if your portfolio is lagging behind, it might be time to reassess your strategy. Now, it's important to remember that indices are just a representation of a particular segment of the market. They don't tell the whole story. Just because the S&P 500 is up doesn't mean every single stock in the index is also up. There are indices for pretty much every sector and market cap you can think of. Technology, healthcare, energy, small cap, mid cap, you name it. This allows investors to track the performance of specific areas of the market that align with their interests or investment strategies. So, next time you're watching the financial news and hear about a market index going up or down, you'll know exactly what they're talking about. Here's a golden rule of investing. Don't put all your eggs in one basket. Why? Because if that basket falls, you're in trouble. That's where diversification comes in. It's like investing safety net. Think of your investment portfolio as a delicious pizza. Instead of just piling on one topping, boring, you want a variety of flavors and textures. The same principle applies to investing. Diversification means spreading your money across different asset classes, such as stocks, bonds, real estate, and even alternative investments like gold or art. Each asset class has its own risk and return characteristics, and by diversifying, you're essentially hedging your bets. But diversification doesn't stop there. Within each asset class, you can further diversify by investing in different sectors, industries, and geographies. For example, instead of putting all your stock market money into tech companies, you might also invest in healthcare, consumer staples, or energy. This way, if one sector takes a hit, your entire portfolio isn't doomed. Diversification helps to cushion the blow of any single investment's poor performance, potentially smoothing out your returns over the long term. Remember, diversification is not about eliminating risk entirely. That's impossible in the stock market. Instead, it's about managing risk effectively and reducing the impact of market volatility on your overall portfolio. Think of it as building a resilient investment strategy that can weather any storm. When it comes to the stock market, it's essential to have a referee to ensure everyone's playing fair. That's where regulatory bodies come in. They're the rule makers and enforcers, working to maintain a level playing field for all investors. In the US, the main regulatory body is the Securities and Exchange Commission, or SEC. They're like the sheriffs of Wall Street, responsible for protecting investors, maintaining fair and orderly markets, and facilitating capital formation. The SEC has a whole bunch of rules and regulations that companies and financial professionals must follow. These rules are designed to prevent fraud, insider trading, and other shady practices that could harm investors. They also require companies to disclose important financial information to the public, ensuring transparency and allowing investors to make informed decisions. Think of it like shining a light on companies' financial dealings, making sure everything is above board. Now, regulations sometimes get a bad rap for being too complex or burdensome, but in reality, they play a vital role in maintaining investor confidence and ensuring the integrity of the market. Imagine a stock market without any rules. It would be like the Wild West with fraudsters and manipulators running rampant. So the next time you hear about the SEC or other regulatory bodies, remember that they're there to protect investors like you and keep the market functioning smoothly. It's all part of creating a fair and transparent environment where everyone has the opportunity to succeed. That's it for today's stock market crash course. We've covered a ton of ground, from the basics of stocks and stock exchanges to the importance of diversification and regulation. Remember, investing in the stock market can be a powerful way to build wealth over time, but it's essential to approach it with knowledge and a solid strategy. If you found this video helpful, give it a thumbs up and subscribe to my channel for more finance and investing insights. I'm constantly putting out new content to help you make smarter financial decisions and achieve your financial goals. And hey, don't be shy. Share this video with your friends, family, or anyone who wants to learn more about the stock market. Let's spread the financial knowledge and empower everyone to take control of their financial futures.